Hey, had a great conversation with Brian here. We're talking about how do you scale real estate? How do you go from flips and rentals into commercial property, apartment buildings by raising capital? And that's what Brian talked about. So check it out.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 489. Many real estate investors get stuck in the cycle of buying single-family rentals and small multifamily properties, only to discover that true financial freedom remains frustratingly out of reach. My guest today, Michael Blanc, is a real estate investor, best-selling author of Financial Freedom with Real Estate Investing, and the CEO of Nighthawk Equity, where he controls over $300 million in multifamily real estate. He's also the host of the popular Financial Freedom with Real Estate Investing podcast. Today, we'll discuss why you're unlikely to quit your job with single-family homes, how to scale your real estate portfolio with apartments, and his proven strategies for raising your first $1 million for multifamily deals. Michael, welcome to the show.
Brian, great to be here.
It's a pleasure to have you on the show because before I even started this podcast, and I've been hosting this for 9 years, you were one of the only other real estate podcasters out there. And I think you were the only one talking about multifamily at the time.
I think that's about right. Yes, it started in 2014.
I started this podcast in 2016. And the other thing I remember about listening to your show is that you got started with a 12-unit multifamily, just like I did. So I too started with a 12 unit. So I thought there were a lot of similarities there. And I stopped listening to your show as soon as I started this podcast because I didn't want to rip off what you were doing. And I know it's changed quite a bit over the years. But tell us a little bit about your background for those who don't know who you are and haven't read your book or listened to your podcast. Fill our audience in.
Growing up, taught to go get good grades, get a good job with benefits, which I did. I have a master's in computer science, Brian. I'm highly educated, which I then threw away some years later. And I was in the right time, in the right place in the late 90s at a company called Web Methods. It was a software company. I was one of the early employees there. And that company went public 3 years later in March of 2000, at the time, the most successful software IPO. And it put a bunch of money in my pocket. And in 2004-05, I read Rich Dad Poor Dad, and it really threw me for a loop. So much so that after about 3 months of confusion, I came home and to my wife and I told her I had quit my job because I wanted to pursue financial freedom. And while I had a bunch of money in with Morgan Stanley at the time, there was really very little passive income coming from that. And I wanted to change that. And so I did a whole bunch of stuff. I studied all about making money and how money works. I traded stocks and options. I flipped a couple houses for good measure. I took a commercial real estate class. But my big idea, the big move, was to get into the restaurant franchise business. Of course, that's what you would have done as well. And that worked well for a couple of years until the recession came around. And then it really stopped working a lot, so much so that I ended up losing my IPO millions. I had 8 restaurants up at one point. I was the largest franchisee, but I lost everything and added a couple of $100,000 in debt on top of that. And then I thought I would claw my way out by flipping, because I flipped a couple of houses in 2006 and 2007. And so I started flipping houses, borrowing money from hard money, and then I started borrowing money from private individuals. And in 2011, I accidentally got into this 12-unit property that you're talking about. One of my wholesalers brought it. I remembered my commercial real estate boot camp, and I said, all right, I'll give it a crack. And it was a complete nightmare. I did everything wrong in this deal. I had the wrong property management company. I had a professional tenant. I was fighting with the planning commission, the inspectors, the HUD inspectors. And I immediately regretted getting into that. But once it stabilized after about 18 months, I realized what passive income really was. It's mailbox money, and it's not flipping houses, which is a lot of work. And that's kind of when I started pivoting into talking about it, blogging about it. That's when I started my podcast and published a book in 2018. I kind of built a community and started building some educational content around how do you raise money, what is syndication, and things of that nature. And so We also buy real estate with about 2,000 units that we have in our investment side as well. My passion really is financial freedom with real estate. And it's typically not in the way people think, which is with rentals and flips.
Tell our audience then where you're kind of positioned, because I know you talked about your experience with single families, fix and flips, but you kind of have a very distinctive view on investing in single families, small multifamilies. And I believe there's like a certain niche in the multifamily apartment world that you really like to go after. Can you talk about that let our audience know what that is?
I talk about the sweet spot, especially in kind of early on, around the 50 unit mark, right? So it's not so much the duplexes. Duplexes, are interesting, but they're not going to move the needle for a lot of people. On the other hand, people want to go big or go home. And so, they want to go for 100 plus units. That's fine also. But typically the sweet spot is around 30 to 50 units, especially for the first deal. That means you might have to raise $1 million or so, which sounds overwhelming for many people, but it's actually easier to do than most people think. And you don't have to raise it all yourself. It's very, very common to joint venture in this space. Unlike with single family houses, that's not really necessary, required. But in multifamily, it's almost always a requirement to joint venture with somebody else.
My portfolio, the duplexes, the smaller multifamilies, they really don't throw off much cash flow. They appreciate nicely, in Grand Rapids values are rising. But as far as cash flow goes, they don't make much. I always think duplexes are great if you want a house hack and get into investing. But I do one of the things I learned early on is you want to have enough units that you can have, full-time manager, maybe an on-site manager. But when you're at that 30 to 50 units, you're not quite there. I've heard, the number that sticks out is like 90 units to 100 units that you can really employ someone full-time. So how do you look at the management and just the economy of scale when it comes to 30 to 50 units versus a much larger multifamily?
I think the 30, 50 is where many people get started. But like you said, it's better to have those economies of scale, and particularly the management. For a 30 to 50 unit, you're going to have a part-time manager, which is not as good as a full-time manager. Depending on where you are, 75 to 90 units is probably the right size you're talking about. So you really want to get to the point where you have a full-time manager. You're going to get better results. But again, 100 unit might be a bit out of reach for the first deal. It's also unnecessary, right? Because if you set the bar too high, you're never going to get a deal done. You want to set the bar so that you do a meaningful first deal within the next 12 months, right? So many people can buy a duplex tomorrow, very achievable, but not very meaningful. On the other hand, 100 unit is very, very meaningful, but maybe not so achievable. So depending on where you are and what your resources are, you pick something that's both meaningful and achievable.
I've also heard you say, like, after you do your first deal, it's a lot easier to do your next deal. What have you noticed from your students and just from your own portfolio, whether that's true or not?
I call it the law of the first deal, really, and it's literally universal. And that first deal is almost always the smallest. It takes the longest. It's the hardest to do. But then when you close that first deal, the second really follows in rapid, almost automatic succession. And it's really because brokers who maybe weren't taking that seriously are now calling you because now they heard you close the deal. Investors that were maybe on the fence in the first deal, like, oh gosh, I missed that one. And so you really become a deal and capital magnet. And a lot of people, it's not uncommon, by the time you close your first deal, you already have that second under contract.
How'd that work for you? I mean, I know you had some problems with your first 12 unit, but how quickly were you able to get into your next deal? And what did you learn from the first one that educated you on the second one?
It didn't work for me at all. And typically when people ask me, what did you do? I will tell people what not to do. I call myself the crash test dummy of financial freedom. So whatever I did is the exact opposite of what people should be doing. So I maybe purposefully or whatever, subconsciously made all these kind of mistakes so that I can spare people from making those mistakes. And what we've done since 2014 is really kind of figure out what are the systems, what is the actual steps to getting a deal done fastest. But in my case, literally on every single example, that is an example of what not to do. In my case, I did not get my second deal done until about, many years later, like 5 years after that. And that was for several reasons. One, I was trying to extricate myself out of my restaurant business. It took an extraordinarily long time to get myself out of the restaurant business and sell that thing, sell all these locations. And then also in my mind, I didn't turn multifamily into a strategy. It was kind of this accidental thing that I did because, like I said, it took about 18, 24 months to stabilize that thing. So I was into 2013 until this light bulb went off. And so to me, I didn't experience the law of the first deal, but I'm like the only one on earth that hasn't. so almost everybody since then has.
Let's talk about just kind of that transition you made. So you started investing in the multifamily. At some point, that light bulb did go off, and you said, "This is what I want to put my money down on." Probably once you got out of your restaurant business, I'd imagine. Where did you go from there? Like, was it more about building your education platform, or were you also building your portfolio at the same time?
It kind of came a little bit at the same time. So while I was trying to get out of the restaurants, I was blogging about multifamily because I was now an expert. I had a single 12-unit deal. So I was blogging for the Bigger Pockets, and I have 151 articles on the Bigger Pockets. And so I was really sharing how to do that. But to me, the light bulb really went off after that place quieted down, and it was sending me like $1,500 a month in mailbox money. And that's when the insanity of what I was doing kind of hit me, because you were flipping houses. If you're not buying, fixing, and selling houses, you don't make money. And then when you do sell it, there's no residual. And that's not really what Robert Kiyosaki talks about in Rich Dad Poor Dad. That's not passive income. And I did go through the mental exercise of maybe building up a rental portfolio. But as you know, this rental property doesn't make a lot of money. If you can make a cash flow $100, $200 a month, you're doing well, assuming nothing major goes wrong. And if you're trying to generate $10,000 a month in passive income, you got to own like a lot of rentals, like 50 at least. And that to me didn't seem very practical. It would have taken me 5 years of about 10 a year, which is a lot. And I really didn't feel like that was a good strategy. So when this apartment building finally quieted down, I was like, and I'd raised money for that. So that was an actual syndication. I was like, oh my gosh, I continue buying properties like this if I can continue raising capital. And so what happened is I was blogging about this and creating a community and answering questions. People were bringing me deals. So they were bringing me deals, and they were offering to invest in any kind of deals I would have. And so I was basically the first 8 deals we did from 2016 to 2019 were like all joint ventures with people. And so that allowed me to scale very rapidly until we realized that having properties all over the Southeast probably wasn't a great idea from an asset management perspective. And we started to kind of step it up a little bit. And we're like, oh my gosh, we actually have a really big company. And we need to act a little bit more professional. And so we need to shine a light on asset management and things of that nature. And so in 2017 is when I started Nighthawk Equity. And so over the next couple of years, we realized that we needed to focus on one particular market. And that market for us was primarily Atlanta. So we stopped buying stuff all over the place, started selling some, and then just went deep in one market.
What caused you to choose Atlanta?
There's a lot of really good markets. They're growing. The Sun Belt is growing in general. So, variety of good markets, Phoenix and Houston, Dallas, Austin, but also Charlotte and Atlanta. So there's a variety of good markets. I don't know exactly why we picked Atlanta, but we just liked the market. And we felt there was a lot of people at the time in Dallas, maybe. So we just kind of said, there's so many different ones to choose from. It was big enough to sustain deal flow. It was growing, long-term outlook was good, and so far we've been right about that. But again, there's many other markets. That's not the only market out there that's worth investing in.
So when you talk to your students and they're buying those 30 to 50 doors, one of the things that you also talk about is how to raise the money for those properties. Can you go into that a little bit? Like for any listener here who might have in their pipeline a 30 unit that they don't know how to take down, what would you advise them?
Raising capital is key, right? A lot of people, even though they read Rich Dad Poor Dad and Robert Kiyosaki talks about OPM, other people's money, they just feel like it's not for them. They feel like it's this advanced thing that maybe they'll learn about, I don't know, when they're much older. But the truth is, it's a strategy that almost anybody can master. It's actually a lot easier to raise capital than people think, because it's not so much you're not trying to sell or manipulate people into invest or begging even for money. It's really you're sharing something about an alternative investment that many stock market investors are looking for, because with the stock market, there's a lot of volatility in the stock market. There's also very little cash flow, and you can pay a lot of taxes and gains. And by investing in real estate, you can help people with that. And a lot of people don't want to be active landlords. They're looking for a passive way to invest in real estate, and they don't know how. And syndication is really the only way to do it. You get a lot of benefits of the real estate, the returns, the cash flow, the tax benefits, but without actually having to do the work. So if you say, hey, I can allow you to invest passively in a commercial real estate, they're going to go, and some people are going to go, how do I do that? And so they lean in and they become very interested, and you're not really selling them on anything. You're simply educating them on something that actually helps them. And so within 30 days, people can learn how to raise money. In 60 days, they're becoming very confident in raising money. And number two, we talked about earlier, is people don't have to raise all the money themselves. It's very, very common to joint venture with people. And there's two kinds of people in a syndication. One is more the deal finder. These are people who are a little bit more numbers oriented, a little bit more detail oriented. They tend to gravitate from a personality perspective more in finding deals, analyzing deals, talking to brokers, doing due diligence, more the operator side. And then there's more of the capital raisers from a personality perspective. They're more relationship people. They like to talk to people. They might have some kind of sales background, and they don't really love numbers. And so those people from a personality perspective are much more suited to raise capital. And so those people will do what they love to do, and they start raising capital. And it's not uncommon for those kind of people to be able to raise $500,000 even on their first deal. But their problem is they're not analyzing deals, they're not talking to brokers, so they don't have that deal. So in our ecosystem, we always put them together. And so now you got a deal finder, and then you got a capital raiser. And so even the deal finder needs to learn how to raise capital, but they don't have to raise all of it. So this is typically how a lot of our students in general can come up with $1 million to buy a $4 million property, because the deal finder finds a deal, raises a little bit of money, and the capital raiser, or maybe even two, kind of close the gap. And this whole idea is just so new to people. Raising money is new, just that idea. But the idea of joint venturing with each other is wild. And that's really the magic of syndication.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB & Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. Since you mentioned syndication, for those of our listeners who aren't familiar with it, could you go into just some of the rules? Because it's not as easy as just going on Facebook and saying, hey, invest in my deal. There's a certain way the SEC, the Securities and Exchange Commission, asks you to do it. And I don't want to go down like a whole rabbit hole, but what are some of the main brush strokes that people need to be aware of if they are going to raise capital?
Syndication is just a fancy word for partnering between two groups of people. One is the operator, the general partner. Those are people who are doing all the work. And then the limited partners or LPs, who are the passive investors who put up all the money. So GPs do all the work, LPs put up all the money, and they split the deal. The GPs get sweat equity in the deal, typically 20, 30 something percent, for finding the deal, putting it together, raising the money, managing it, and then presumably selling it for a profit. And the LPs get a return on their money, typically 15 to 20% average annual return, 5-6% cash flow, and then significant tax benefits for investing in the deal. And that's really how these large deals are being done on a syndication. You mentioned some of the ways to pay it. You got to pay attention to how you raise money, and we'll keep it high level, but your attorney will guide you in that. But you're right, you can't just put up a billboard or a radio ad and advertise a deal or on social media unless you're doing a 506C. You have to develop personal relationships, which in the beginning isn't much of a limitation. In the beginning, you have to raise money one-on-one, get referrals, right? So putting stuff on social media to strangers isn't going to benefit you in the beginning because you don't have any track record. How are you going to build trust with someone on social media? You can use social media to augment the trust that you've already built in one-on-one. And so, yes, you're right. You can't promote the deal itself, but you can promote your content or yourself, or that you visited a property. You can encourage people to book a call with you. You can do all those. You can do a lot of things. So not being able to advertise online is not a limitation. And we did 23 deals before we did our first 506C. So it's not really much of a limitation at all.
When you're talking with students, and because you do a lot of training and education, what are some of the factors that they bring up that are holding them back? What are the reasons or excuses people use to not be able to buy real estate?
I think it's a comfort zone thing, especially for people who have never done real estate before. I think those people, there are some, but many people who have never done a real estate transaction, a rental or flip, just the idea of doing that and just jumping over that, what they feel is a stepping stone, is a pretty big step for people. People who have done a rental or a flip are much, much more inclined to get into multifamily because they understand two things. One, they understand the benefit of real estate because they've done it, but they also understand the problem, which is they can't scale it. They can't actually get the financial freedom. So they understand the problem. They may not always go, oh, yes, I need to get into multifamily. But they're like, I got to do something. I got to figure out how to scale this thing. And they're looking and they're seeking. And that conversation is much easier to guide them when they're already aware of the problem and guiding them to multifamily. And once they're there, they might have, the two objections I hear most frequently is, hey, I don't have the experience. Let me do another 5 or 10 years of this thing and I'll take my experience and the money I make and I will, quote, graduate to apartments. And that is the unnecessary step. You don't actually need 5 to 10 years of experience. You can literally learn everything you need to know and build a team around you within 30 days so that you appear like you're an seasoned investor when in fact you're really not. And again, you have to raise the capital. You don't have to save money or build equity in your house and get a HELOC. The key is getting and learning how to raise capital.
And what's your outlook on the market in 2025? We're in a strange period here where with high interest rates that stubbornly don't seem to be coming back down. By the time this comes out, we'll know whether they've gone up or they might go down. And there just seems to be a lot of people sitting on the fence, buyers who don't want to come down in price. Sellers who don't want to come down in price and buyers who don't want to come up in price. What are you seeing out there? Are you seeing deals getting done?
I do. Right now, the environment, the outlook is vastly different than it was 2.5 years ago. 2.5 years ago, and it was March of 22 was the height of the market, in hindsight, highest prices. And the outlook really wasn't that good back then. And that was because interest rates were at all-time lows. They couldn't really go any lower. And the leverage you can get from lenders was the highest. It's 80% of loan to cost of not only the purchase price, but all their closing costs and construction, highest ever, right? So if you look at it, the risk level was the highest literally like 2.5 years ago. And now it is completely opposite. Now prices are down 30%. The leverage is extremely low. If you're lucky, you're getting 70%, and that's only the purchase price. No one's funding fees and no one's funding construction at the moment. So your risk is much lower and your outlook from an interest rate perspective is flat to down, right? 2 years ago, it was most clearly up. Now, no one could forecast it would go up so quickly, so fast, but the projection was up back 2.5 years ago. Now the projection is at least flat to possibly down. And so that entire market outlook is shifting. And so to me, the risk is much less now, and the outlook historically is much, much better.
And are you seeing deals that pencil out with sellers who are willing to come down in price to sort of take into account higher interest rates, higher insurance, things like that?
It's starting to come back a little bit. I think a lot of the sellers, when the market pulled back, they're like, I didn't want to sell anyway. I was just going to sell because someone was dumb enough to pay me this kind of money. They're like, I'll just sit this thing out. But now that's 2 years ago, right? And the sellers that wanted to sell back then and couldn't and missed the window, like, I'll just wait another year. Now it's been 2 years. And so we're seeing some of those sellers come back and just realize some of the gains they've built up over the years. So it's, and the market has been normalizing. A lot of expectations have been resetting. So we had this giant gap in, when sellers wanted and what buyers were willing to pay. And so the volume was down by like 81% at the low point, like transaction volume was down. And so the transaction volume has been increasing slowly with time. So we are seeing an increase, not only for ourselves, but also with our students, of more and more deals that are penciling.
Michael, how would people find out more about you, get a hold of you, learn more about your training?
The best place to go is thefreedompodcast.com/Brian. And on thefreedompodcast.com/Brian, we have some resources for getting to know more about apartments. We have this free training class called Apartments 101, introduces people to syndications. And if someone is interested in learning more about investing passively, there's also a free training on what that looks like if to invest passively in syndications. So that's for you only, thefreedompodcast.com/Brian.
What is your favorite hack or app?
I love WhatsApp. So a lot of people, Americans, don't use WhatsApp. I use it internally with my family and friends and also with my team. And what I like about it is, this is the hack part, is I can have asynchronous conversations throughout the day with people versus having to set a call. So that just came to mind. Not a lot of people use WhatsApp, but I love it.
Michael, thanks for coming on the show today. I mean, I've always enjoyed the fact that you had that podcast out when no one else had a podcast on multifamily real estate at the time. And it's great to see that you've continued that and been so successful with it. And I appreciate you coming on the show today to talk about multifamily, how you're investing in it, how you raise money and teach others to do that. So thanks so much for having this conversation today.
My pleasure. And it's been great here. Thanks for having me, Brian.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group. And you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.